Hi, my name is Arslan, and I'll present you my analysis of Tencent.
Far less known than Facebook, Google, or even Alibaba for obvious reasons, Tencent is nonetheless one of the big 10 companies in the world. Its messaging platform has a flow of more than 800 million users per month. Although on a positive trend, you can see from the chart that the stock has experienced big move during the year. Global equities had positive return this year with some challenges. The Hang Seng Index has been the most affected of the three charts. The iShares Global Tech in green has outperformed the MSCI World Index after underperforming during the first half of the year. The industry outlook remains positive in our view. The mobile area is changing radically the sector, and this is creating a lot of growth opportunities. In terms of valuation, although it's hard to find mispriced assets in such an environment, the second chart shows that the Hong Kong firm seems to be trading at a discount, which is in line with the chart above. Assessing the firm's M&A skill is difficult given the lack of data about the deals. Besides, Tencent tends to be more focused on revenue synergies rather than cost synergies. This explains why the margins are not increasing after the transactions. The multiple comparisons show that the firm is not cheap when compared to peers. However, the good news is that Tencent has been trading at a premium for a number of years. Besides, when we adjust for the economic returns, Tencent is just under the regression line, suggesting that the firm is not overvalued. This is not the case of one of its major rivals, Alibaba, which is trading at a very high value-cost ratio. Tencent and its competitors are part of a huge market war when each try to get in the business of the other. Although it's a risky strategy, we think that it is the only way to consider the market power of each. We like about Tencent is proven strategy that drove economic return to higher levels. The fact that 50% of its employees are in R&D and its high asset turns compared to peers. Our valuation model is indicating that the company is traded at a small discount. This makes us comfortable as the assumption we used were not high in our view. The key assumption we made was the slowing growth opportunities and thus pressure revenue growth, the increasing monetization, and the higher margins. The economic valuation using the CFROI inputs gives us a higher price. This price is based on a decrease in CFROI toward 27% 5 years from now. The asset growth is also expected to decrease to reach 18% in 5 years. Both valuations imply a risk of deviation. We identify the cost pressure and the high competition as the major challenges to our valuation. The saturation of the Chinese market raised the needs for an external catalyst that can be found in other emerging and developed countries. Tencent is already targeting countries other than China. However, in our view, this must not be done at all costs. Tencent should focus on countries like India, Brazil, or Japan, in which the access will be a lot easier for many reasons, such as the low penetration of rivals and local firms, the potentially lower cost, and also the high population. We also recommend Tencent to build partnership with strategic players in different countries. This will help the firm expand more efficiently in terms of cost and risk sharing. Chinese tech firms are usually considered less innovative than their US peers. In this matter, Tencent must always be focused on finding new products, contents, and technologies to avoid losing its market share. If we take Didi Dash for example, we think Tencent could take advantage of launching a premium service to wealthier clients. When we look at the firm's asset growth and the number of acquisitions, we thought that some premium could be saved by decreasing in part of external growth. This would help the firm decrease its acquisition efficiency. The increasing costs during the recent period raised the concern about the firm efficiency. We are well aware that a large portion of spending is completely justified given the competitive environment, but we think that the firm could also unlock some value by gradually decreasing the SG&A expenses. Tencent could also optimize its capital structure. The low rate environment combined with a low debt proportion will help increase the firm's value. The firm could also move to a level 1 ADR or higher. Even though being listed in Hong Kong, we don't see Tencent having problem attracting investors. However, this could help non-institutional investors to be positioned in the stock. This could also help the firm being recognized in the US. Finally, although the literature is mixed on the bonding theory, some researchers found positive effects on the cost of capital and the premiums required by capital providers. In conclusion, we see Tencent being well positioned in its market. It has a strong balance sheet and an appreciable market share. We are also confident about the growth prospect for the firm and its sector as a whole. We see little downside risk even though Tencent is still facing some challenges. Therefore, our recommendation is to buy the stock at the current market price. Thank you for watching.